The chief executive of JP Morgan is predicting, in his words, a kerfuffle in the US Treasury bond markets. Jamie Dimon says he expects the Fed to step in to calm things. The bond market has been moving in a strange way lately. Stocks have fallen. When that happens, tend to move into safer assets like US Treasuries, when you loan money to the government at a particular rate. When more investors want Treasuries, the yield tends to fall. It's an inverse proportion. It's a classic. The price goes up, the yield goes down, and vice versa. That's not what's happened now. Stocks have fallen and bond yields have actually risen. In other words, bonds have fallen, which suggests that people are selling. Richard Clarida is a global economic advisor at PIMCO. He was the vice chair at the US Federal Reserve. It is always excellent to see you, Richard, always excellent. Now, what do you make of the bond market movements that we saw? What were those movements telling us?
Richard, great question, and it's been too long. Thanks for having me on. This week has been quite dramatic. As you mentioned, what has happened this week is, bond yields have gone up, even though evidence of a slowing economy. And obviously the turmoil in stock markets in particular also yields up and the dollar weaker. Up to this week, year to date, stocks were down and bond returns were positive. So we're really just talking about the last 4 or 5 days. But yeah, it's been quite eye-popping to see what's happened.
So why do you think that's happened? One quote that I see is a complete loss of faith in the strongest bond market in the world because you don't know about the economic policies of this administration. Do you think it is that? In other words, sell everything and get out of the US? Or is there an element in this of shorts having to cover on margin calls and therefore selling? In other words, what we're witnessing is the plumbing of the financial system having a bit of a blockage and a burp.
Richard, I think it's certainly that there are some technical factors. Unwind of Treasury trades has certainly been a factor. I think the other thing as well, which maybe folks have not noticed in all the tariff attention, is the fact that the fiscal news out of Washington this week was pretty bad in the sense that there was the House more or less agreed to the Senate's reconciliation bill, which has a lot of tax cuts in it, but not a lot of spending decreases. So whatever your view of the budget deficit was a week ago is probably worse right now. So that may have been a factor as well.
On this question, how I see one of the current Fed governors has basically been saying the Fed would obviously intervene, or at least would, if not, it wouldn't allow a disorderly market. But what would you do if you started to see yields getting out of alignment to what fundamentals should dictate? How would the Fed move in terms of liquidity? Because one of the issues has been when we say that there's been liquidity problems, obviously it's still there. It's the largest, deepest market in the world. But smaller transactions are moving prices in a disproportionate way.
That's certainly true. And there are other indicators this week, including, bid-ask spreads and the repo, how the repo market works. And in my view, they were flashing yellow. They weren't flashing red. I was at the Fed in the spring of 2020 when they were flashing red. So I think, but to get to the first part of your question, Richard, I have no doubt that if market dysfunction got sufficiently concerning, that the Fed would step in. They would, I think, try to distinguish between that and a rate easing or a QE program. They would hopefully make it very limited and targeted, more or less like the Bank of England did 3 years ago following the Liz Truss budget. So I think there's conditions under which they do step in to support liquidity, but I think the inclination would be to make it a pretty limited operation in terms of duration.
I always hear people say, somewhat fancifully, the Chinese with their $1 trillion in bonds could screw over the United States if they started selling them. if they started, of course, they'd do themselves a lot of economic damage at the same time. When you were at the Fed, did anybody ever seriously think that the Chinese would use their US government holdings as a weapon?
I didn't. During my 4 years there, which were eventful, that was not something that was on my, or I think our radar screen. What we did see in March of 2020 was a lot of foreign central banks. I'm not singling out the Chinese in specific. A lot of foreign central banks needed to raise liquidity, and so there was some selling for those reasons, but nothing along the lines that you described when I was there.
This tariff policy, yesterday Janet Yellen said it was like taking a wrecking ball to a previously well-functioning economy. How would you describe the tariff policy that we're seeing today?
Well, we have the tariff policy of 9 days ago, and then obviously this week, at least many of those tariffs have been suspended. So I think the one thing I am confident about, Richard, is that there's a lot of uncertainty about U.S. trade policy, and that in and of itself is a headwind to growth, to investment, potentially to employment. I think we know that for sure. The other thing I can say for sure is that even if the 10% tariff stays in place, notice I'm saying even, right before coming into this year, tariffs were about 2% of GDP.
Exactly.
So even if it's just that 10% tariff, that would be the highest tariff rates we've seen probably going back 70 or 80 years. And that in and of itself is going to be felt in the economy, at least in the first initial quarters. But I think the main conviction I have is that it's very hard to know where we're going to end up with tariff or trade policy, 6 months or a year down the road.
I listened to Chair Powell talking about all of this, and in his last speech recently on monetary policy, and the Fed is still sort of talking about rate cuts later in the year, almost as if the Fed is looking through the inflation consequent of tariffs, almost because they can see it, and provided it doesn't become systemic and self-feeding in terms of a wage cycle or a wage spiral, if you know that that's where the inflation's from, you can sort of look through it and beyond it, and you can continue regardless, particularly if there's going to be greater weakness. Is that a justifiable view?
Richard, I think you well characterized the communication from the Fed up through the March meeting. In fact, I think you've nicely summarized where I think the Feds were before April 2nd. The chair had an opportunity to speak on I guess, the Friday of last week. And my takeaway from his comments there were more guarded, acknowledging that the upward pressure on inflation could be both larger and more persistent than they had thought, and the downward pressure on the economy and the labor market could be more material than they thought. And I think that right now, we heard from President Williams today, I think right now they're thinking that they're just going to really stand pat. I do think if we see a cracking in the economy, higher unemployment, that they would respond, but I don't see them cutting simply based on a forecast that things may get bad. So I think in some ways, the Fed has maybe moved to a more on the sidelines perspective than we may have interpreted at the March meeting.
I'm grateful to you, sir, as always. Thank you. Have a lovely
All right.
weekend.
Thank you, Richard.